Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500. We've really seen a crazy market for the past few months, and this has brought us up to a big channel resistance. I've seen a lot of people talk about this mega price channel here that goes back to the 1950s, captures the reaction lows from 1974, 1982, 2008, and also acted as resistance throughout this entire period in the 1950s and 1960s. Then it was respected here in the 2000s as you saw a breakout, retest, and eventually a break back down below, retest. So I've seen a lot of people on social media call the top right here. In fact, you can see we've rejected off that level right here. You do have a red monthly candle from September. So we're going to discuss that in this video, discuss how this compares to everything else that we've been talking about over the past few weeks. This really has been a crazy market to navigate, and we think those crazy moves are very far from being done. We intend on taking advantage of them. So make sure to hit that subscribe button if you're interested in following these markets with us. And now, without further ado, let's get right into it. All right, so let's start off with the long-term technical picture. This is, without a doubt, an important level to watch. When you have such large reactions like this on a chart, on a longer term log scale chart, especially when it captures such large reaction lows like this, you can be very confident the market participants are watching this level right here and this entire price channel, right? Even throughout the entire bull run here, you can see that the markets respected these levels perfectly, corresponding to reactions, breakout, retest, resumption, retest once again in 2019, retest once again throughout the COVID crisis. So this is a valid level. There's nothing to say about that. But I want to add one more channel on this chart corresponding to the big channel that we've been looking at. And that channel actually captures quite a few reaction highs on this bull market here, right? This is the 2009 to 2020 bull market. And the bull market on the S&P 500 has respected this line as support and as resistance on most of the big reactions that we've seen, right? In 2018 here, you had a brief dip below during COVID, but snapped back above. And we recently broke out of this channel and were sandwiched right between these big long-term levels, support and resistance. So these are both levels that market participants are watching. And so which way it breaks out or down depends on the market environment, and it depends on the macroeconomic landscape. So that's exactly what we're going to discuss next, where we think the S&P 500 is going to go next and why. Because once it picks a direction, you're going to see violent moves either to the upside or to the downside. So we need to be on the right side of that trade. Now, the first chart that I want to show you guys is TLT. This is the Treasury bond ETF. And so if you know anything about the markets, you'll know that stocks and bonds tend to have an inverse relationship, right? When one goes up, the other goes down, and vice versa. Perfect example of that is between November 2018 and March 2020, where you had this big massive rally on the bond market. And if we compare that to the S&P 500, you can see we saw extremely poor performance throughout that period. So when Treasury bonds are going up, it tells you that investors are seeking safety. So you don't want to be too heavy on stocks when bonds are going up. Now let's see the last big development that happened on TLT, and that was the rejection of this resistance level right here. That's a big violent rejection telling us that bonds are still in a downtrend. So we've got a market environment where bonds are falling, and we think they're going to continue falling as we continue to see elevated rates on the CPI here. We just got the September reading that was higher than expected. We have inflation rates at 5.3%, and the 10-year Treasury bond yield is at 1.61%. So if you're holding bonds right now and you're seeing these inflationary readings, why would you be holding? You're going to be selling your bonds and getting into the stock market, getting into Bitcoin, getting into gold, anything but bonds and cash. There's too much inflation right now. Now we are seeing a small bounce on TLT. If you're following us on Twitter, you'll know that this is a pure technical play off that $141 support level. But ultimately, treasuries are trending down. They're still below this downtrend line. We're seeing momentum indicators on treasuries begin to cross down here. And so that's bullish for the stock market. And so in our opinion, now do not blindly follow this information. This is our opinion, but this is all bullish for the stock market. By the way, if you are bullish on our YouTube channel, make sure to click on that like button. It helps push our videos out so much, so it is really appreciated. All right, so what's the number one sector that's been dragging the S&P 500 down throughout the past few weeks? And your answer to that should be very clear. It's the Nasdaq 100. If we compare the performance of the Nasdaq 100 to the S&P 500, you can see it's been dragging it down. In fact, we can actually take a look at the Nasdaq to S&P 500 ratio. And here you can see it's been going down throughout the month of September here, rolling over beginning of September. And we're now right here at this line of support. This is what's dragging the market down. If we add the S&P 500 on top of this chart, you can see every time that the Nasdaq underperforms, it brings the stock market down. Every single time you get a correction, you get an underperformance of the tech sector, you get a correction on the S&P 500 as well. With no exception, every single time, that's exactly what happens. Now, we've looked at this relationship quite a few times before, and so if you know where the tech sector is going next, you know where the S&P 500 is going next. And this is why you come to our channel for this kind of information. On top of giving you guys these relationships, we can actually see the technicals clear as day with this beautiful channel here capturing all these reactions here. And if we apply that same angle, that same trend line, remember the market loves symmetry. We're currently very close to support here. This is a nice zone of support, and it's also a zone of support horizontally. Very strong support here. So this is a nice risk reward ratio for the Nasdaq 100. We expect it to begin outperforming here, especially if we see a small pullback on yields, and that should bring the S&P 500 higher. Now, we actually made a full update on the tech sector and on the market today for our members on our website at gameoftrades.net, where we take a look at the technicals, we take a look at the sentiment, the market breadth, intermarket analysis, and exactly where tech is going, why, and how it's going to impact the market. We also did the same thing for crude oil and the energy sector. By the way, make sure to visit our website update here. It's finally finished. It's finally live. All the content is a lot more organized. You can go through each asset class, each category that you want. We have an investment corner on our website with a complete overview of our strategy for each asset class. So you can actually check out our broad vision, our broad perspective for each asset class, how we're positioning on these assets, and why. This macro section here is probably the most important post I've ever made. It really puts everything that we talk about into perspective and exactly what we think is going to happen over the next few years and how to properly benefit from that. So if you're interested in that, make sure to get yourself a free trial by clicking on the link down below. Now, I wanted to take a look at a specific chart here. This is the SPY liquidity premium. And this is quite a fascinating indicator right here because it tells you so much about what other market participants think about the markets right now. Now, what this indicator shows you is how much investors are piling into ETFs as opposed to less liquid proxies for the stock market, right? So what that means is that when a lot of investors are piling into liquid ETFs, it means that they're scared of seeing a big market drawdown. So they're willing to pay a higher premium for having that liquidity and being able to sell their shares in case things go bad. And you can see throughout the past couple of years, this has been such an accurate indicator of market bottoms. When you have a rising S&P 500 liquidity premium, it tends to correspond to big bottom. It happened here. It happened right here in October. right there in January. And you can see it's potentially happening right now. We're seeing this liquidity premium rise and is currently at levels that you typically see at bottoms of correction. Now, of course, if this is the beginning of a bear market and we're heading much lower, then you can see this liquidity premium can still rise a lot more. But this is just one more indicator that's telling me that the risk reward here is very favorable. We don't think that we're heading into a bear market right now. We've highlighted that in most of our previous videos. We think that this is a technical correction. And so seeing this type of development is bullish for the short term. Now, another indicator that we love to use is the Investor Intelligence Survey. I don't think I've talked about this indicator on this channel before, but this is probably an even better indicator than the AAII sentiment because it takes into account a variety of surveys. And you can see this indicator is telling us that the number of bears here, so the number of people that are bearish on the market, is skyrocketing. And the last time we saw this type of a rise in bearish sentiment was during the pandemic here. And we're definitely not in a comparable situation to back here in 2020. Before that, it was in 2018 because the Federal Reserve had raised rates significantly, and that triggered a large correction on the stock market. So we're seeing big bearish sentiment similar to the levels that you typically see near big market bottoms. Hopefully you guys enjoyed this video. Hopefully it was useful. You learned something new and it gave you a broader perspective on the market. If that's the case, make sure to click on the like button to let us know. It helps us grow our community so much. So it is really appreciated. Now, in the meantime, I wish you good luck on your trading and see you next time.